5% by the second half of 2024. Additionally, whereas there are downward inflationary pressures arising from the continuing vanishing effects of supply-side shocks, receding inflation around the world, and improved domestic food supply, these are likely to be outweighed by the effects of a weaker shilling. The inflation trajectory going forward would be shaped by the outlook on the shilling and other goods inflation. The inflation forecasts have been revised upwards in the short term, that is 12-month horizon, in light of the exchange rate depreciation. Inflation is projected to rise above the medium-term target of 5% by Q1 of financial year 2024/25 and stay above 5% throughout 2025 unless monetary policy is tightened. Risks to inflation outlook remain highly dependent on global and domestic environment. Specifically, higher global commodity prices, partly due to geopolitical tension and an increase in shipping costs resulting from the Middle East conflict, as well as tighter global financial market conditions, could result in higher domestic inflation. MPC assessed the risks and the uncertainties of the outlook as being broadly on the upside. Economic growth for financial year 2023/2024 is projected to remain unchanged with growth of 6%. However, economic growth in the outer years is projected in the range of 5.5% to 6.5% compared to an earlier projection of 6.5% to 7%. The downward revision of growth in the outer years largely reflects the likely impact of tighter monetary policy, which is required to stabilize inflation around the medium term. In addition, the rise in inflation could depress household real incomes, reducing consumer spending, while investment expenditures could be dampened by high raw material import costs. Moreover, tax revenue underperformance could increase domestic financing, which would crowd out private sector credit growth and dampen economic activity. Furthermore, sluggish recovery in external demand could reduce Uganda's exports. However, strengthening activity in the oil sector and the Financial Action Task Force FATF removal of Uganda from the grey list on February 23, 2024, could unlock additional FDI inflows and somewhat mitigate the negative effects above. Overall, risks to growth are tilted to the downside. The risk to inflation outlook are elevated, and this requires tighter monetary policy stance. Therefore, the MPC raised the CBR by 50 basis points to 10%. The bands on the CBR remain at plus or minus 2 percentage points, and the margins on the CBR for rediscount and bank rates at 3 and 4 percentage points, respectively. As a result, the rediscount and bank rates will rise to 13% and 14%, respectively. Going forward, there are prospects for a higher CBR to bring inflation down and anchor inflation expectations, or lower a CBR if the risks do not materialize. Faster, sustainable growth can only occur in an environment where inflation is low and stable. High inflation rates hurt economic growth, leading to a significant and permanent reductions in per capita income. Therefore, tightening monetary policy in the current circumstances is consistent with supporting sustainable growth, which is a prerequisite for socio-economic transformation. That marks the end of the reading of the monetary policy statement for the month of March 2024. Thank you so much for your kind attention.
Thank you, Deputy Governor. And we now open up the meeting to the public. So you may, as we have already announced, raise up your hand or type in the chat. Your question will be responded to adequately. Okay, so DG, we have Adi Twaha from the New Vision with the Adi, we are not getting. Adi, you are muted. Kindly unmute and ask the question again. Okay, DG, we are unable to communicate with Adi Twaha of New Vision. We ask the members of the public to raise up their hand or type the question in the chat. DG, as we wait for the members of the public to ask questions, Adi Twaha has typed a question in the chat. He has typed two questions. Question number one, he says, BOU last intervened on the sell side on June 2022. Has the current volatility caused any intervention from the side in the FX market? And then two, the demand season is here. And he says that he has not seen many large banks issue profit warnings, meaning they could be in the better place. Will you be in any way be restricting dividend payments as a result of the weakening currency? That's from Adi Twaha.
Okay, Ali, thank you so much for that question. If I got your question correctly, the first one is that Bank of Uganda last intervened on the sell side in June 2022, and you are asking whether the current volatility caused any intervention from your side in the FX market. Yes, you're right that we last intervened on the sell side in the month of June 2022, and to be specific, in the first week of June 2022. And what we have been doing is we've been allowing the exchange rate to be determined by supply and demand factors. And we have all ensured that our intervention on the policy side to regulate the demand is what has actually helped us. You recall that in June 2022, we began the path of monetary policy tightening. And between June and October, we raised the CBR by 350 basis points. And we also increased the cash reserve requirements by 200 basis points. Now, the impact of that was to mitigate the demand on the FX side. But the key objective of that intervention, of those policy changes was occasioned by the inflation outlook, but it had a spillover effect into the FX market. It was not because of what was happening in the FX market. That's why we took those policy actions, but it was occasioned by the inflation outlook, and it only spilled over into the FX market to contain the demand side of the FX market. Since then, we have maintained a tight monetary policy, albeit the minor reduction that we saw in the second or third quarter of last year of 50 basis points for both the CBR and the CRR. So we have allowed basically the supply and the demand forces to determine the exchange rate, while we have been fixing our eyes on the inflation outlook with the spillovers into the FX market. So even the recent intervention, even in the recent depreciation of the currency, we did not see really any strong point of intervening, because we knew that the measures that needed to be taken would need to be addressed by policy measures rather than by intervention. And this is exactly what we are doing. We allow the exchange rate to depreciate, and we are taking some policy actions to ensure that the inflation outlook is contained, and we won't believe that there will be a spillover into the FX market. So, Ali, that's my response to you to the first question. Now, your second question is that the dividend season is here, and you've not seen many large banks issue profit warnings, meaning that they could be in a better place. I don't want to comment on that, because I know that most banks are still finishing their audits before they can declare their profits and then dividends. So I'm not going to speculate whether they are not going to issue profit warnings until we get the audited accounts of these banks and what profits they've had. And maybe from there, they will then indicate the kind of dividends that they want to pay out. Now, you're asking, will you in any way restrict dividend payments as a result of the weakening currency? Again, like I said, the exchange rate will be determined by demand and supply factors. So I don't think restricting dividend payments will be the solution. I think on our part, we will ensure that policy is correct and that the supply and demand factors in the FX market then determine where the currency will be. But let me ask my colleagues, Adam, who is the EDR, and Dr. Twine, who is the EDS, if they have anything to add. Over to you, Adam and Titi.
Sorry, I have nothing to add from my end unless Titi has anything to add. Thank you.
Thank you, Mr. Chairman, DG. I also have nothing to add, just to say you're correct that can only make a decision. The bank will review dividend requests in line with existing policies, internal policies. And the restriction of dividends is never an option or even a good thing to do. And like you said, our decisions are motivated purely by our focus on maintaining inflation, and not necessarily the exchange rate, but they are spillovers.
Okay. Thank you so much, members. We are still waiting for your questions. DG, there is a question from Martin Ruza. And he says, by what percentage has the Uganda shilling depreciated against the dollar since the beginning of this year? And he continues to say that, is there any capital outflows at the moment? Where are the factors causing the revision of the down of the economic growth downward coming from?
Thank you, Martin Luther, for the question. Let me defer to Adam, and then I will come back after Adam has responded. Adam, please.
So the question on depreciation, since the beginning of the year, the shilling has depreciated by around 2.8 on average. That is year on year between January and not. I'm not sure whether you refer to January, but if it is 2 months, January and Feb, you are talking about the depreciation of around 3% or thereabout in January and February on average. We saw depreciation of 5% in Feb on annual basis and around 2% in the month of January. Is that what Luther wanted to get? But on the amount of capital outflow, have we seen a capital outflow? In our computation, we roughly saw that about somewhere in the range of 150 billion between December and February could have exited. There are those who exited the securities and the deposits, and they are sitting in the swap. The swap market is normally where you are just playing around, undecided where you are likely to end. But overall, we have seen about in the range of 150 billion, equivalent billion Uganda shilling that could have left the market between December and February. Thank you, Chair.
Okay. Now, Martin Luther, on your last question, what are the factors causing the revision of the downwards of economic growth? I think, like it was mentioned in the statement, that the tighter monetary policy stance is partly responsible for that, and the slightly limited inflation levels is also going to affect the real income of the households and the investments. So that is why we are revising the growth in the medium term slightly downwards to the 6.5%, 5.5% to 6.5%, as compared to the 6.5 to 7% that we had earlier on.
Thank you so much. Members of the public, you are still encouraged to type your questions or raise up your hand. DG, as we wait for the members of the public to raise their hand or submit their questions, there is an important part of this monetary policy statement that you have just issued. The last sentence, that the decisions that you have made today is a prerequisite for socio-economic transformation. Ugandans would wish to get a bigger explanation into this and how they will participate in several government programs related to socio-economic transformation. Thank you.
Could you repeat the last bit? I didn't get it well.
the last sentence of the policy statement that you have just issued is confirming that the decision that has been made today is consistent with supporting sustainable growth and is a prerequisite for socio-economic transformation. So Ugandans would be interested to know how the decision is made today will help to shape their participation in government development programs, which the central bank has ably participated in.
Okay, thank you so much, Bazizi, for that reading that online question. Maybe I'll start with the first part of that last paragraph, which read that sustainable growth can only occur in an environment where inflation is low and stable. And why is that the case? Low and stable inflation encourages savings and also promotes investments. So in a situation where inflation is very high, you are likely to reduce on your savings and therefore also on the investable funds that are available. So whereas our intention today is to bring back inflation to where we want it to be in the medium term, we've had to take this decision because if we hadn't done that, inflation would have risen to above the medium-term target, which we think would have negatively impacted on the savings and also on the investments going forward. Now, in terms of socioeconomic transformation, you are all aware of the fact that we are now trying to reach to the bottom of the economic pyramid through so many instruments, including financial inclusion, including through the use of fintechs and what have you. There are a number of these fintechs that are now mobilizing savings and extending credit to the very bottom of the pyramid. And this is improving on the incomes of these people because they're facilitating investments and therefore their livelihoods, which is now getting them out of subsistence into the monetary economy and also improving their livelihoods. So higher inflation, if not checked, would result into a situation where these outcomes that I have just described are kind of like constrained. So that's why we have that statement that tightening monetary policy in the current circumstances is consistent with supporting sustainable growth through increasing available savings and investments, which is important for socioeconomic transformation through promoting the livelihoods of those ones who are the bottom of the economic pyramid. Thank you.
Thank you so much, DG. And I'm sure Ugandans have heard for themselves. Allow me also, DG said that there is something important to do with Uganda's removal from the grey list. I think Ugandans would be happy to know the details surrounding this and how it will help their financial activity. Thank you. Thank you.
Okay, I'm going to say something briefly on this, and then I'll ask Dr. Twine, who is the EDS, to add. I think when Uganda was grey-listed in February 2020, we saw some kind of restricted cross-border financial transactions as a result of us being put in the list. We were subjected to a lot of scrutiny by international financial partners. And as a result of that, we saw increased costs of accessing finance at the global level and by the foreign lenders, and also to some extent affected the foreign direct investment. So Uganda's removal from the grey list is expected, of course, to yield some benefits like enhanced reputation in terms of the country's image. We are expecting that this could attract more international investors into the country and increase trust in the financial system. So even the risk-based premium that was imposed on our lending is likely to come down going forward. We're also expecting increased capital flows, given that Uganda is anticipated to become a more appealing investment location. So we think that additional capital is likely to flow in, and we're also expecting faster international transactions to be executed, as well as fewer and lower costs. So the overall effects of the above is to enhance economic growth going forward, and this is what we're projecting. So briefly, that's how we would like to respond to that question, but I know EDS, you've been at the forefront of this. Maybe you have more to add. EDS, please.
Yes, indeed, they are benefits, and you've spoken about a number of them. The risk premium that has been added to the pricing of the credit to Uganda, that is expected to come down. I think, but we think more importantly, over the short to medium term, we should see some capital inflows on investor interest in the country, since now it's a destination that is not. We are no longer frowned upon as a destination for funds. And I think the intention here is that as long as we manage inflation, and then those funds come in, then they'll find they'll be in a better place to be better utilized and have a bigger impact on the economy. Thank you.
Okay, I think, DG, we do not have any more questions. Allow me to bring this to the end. We thank you so much, and the statement will be sent to you through our usual channels, and we shall amplify this through TV and radio talk shows. We are also available to answer any questions via email or telephone contacts and social media. We thank you. Okay, there is one more question in the chat, DG, from Adi Twaha, and it says that the recent infrastructure bond issued by Kenya have any effect on the FX market?
Thank you, Ali. Let me defer that one to Adam, and if there's anything to add, then I can add. But Adam, please.
Thank you, DG. Yeah, to some extent, yes, because you have an infrastructure bond that attracted the yields, I think, above 18% without tax. And as we have already argued, African market is taken as one unit. So the funds by offshore that are allocated to Africa is like a portion. So once one part of the portion becomes attractive, then you see, you expect some exit to where the yields are look attractive, and that's what really we're seeing in the statement, that attractive yields in some of our peers could have also resulted into exchange rate depreciation as exited. So to answer you, it could not. We don't have numbers offhand, but we started seeing sentiments regarding that actually, hold on, your peers are giving better returns in terms of investing in some of their securities. Why should we invest in Uganda, where the yields remain low and they are even taxed? So that element is part of the story. Thank you.
Thank you, DG. There are other four questions from Martin Ruza. He's asking Adam to kindly classify on the shilling depreciation, I think on annual basis. And number two, It says, and also mention the key reasons which drove Uganda's shilling depreciation so fast. Next is how much was private capital inflows last year? And lastly, what is the state of Uganda's earning from the exports?
Okay, thank you, Martin Luther. I think on the numbers themselves, I will refer that one to Adam because he has the latest balance of payments. And so he should be able to speak to that. That's about the state of Uganda's earnings from exports. And then I don't know whether he has anything on capital inflows for last year. But like I mentioned earlier on, what were the reasons that drove Uganda's depreciation so fast? I think I did mention, and Adam has repeated it, that the sharp depreciation that we saw in February 2024 was in part due to the outflow of some offshore investors' funds from our domestic markets. And these funds were pursuing more attractive yields available in other markets. But of course, that only triggered the sharp depreciation because other than that, there were also some underlying causes which are mainly seasonal. And these are to do with the strong domestic demand, particularly after the holiday season in the month of December. So we saw a strong domestic demand, occasioned also by some hedging mechanism against the further depreciation of the currency. And of course, like I mentioned, and other seasonal factors. So it was just mainly two factors, the hedging and then the offshore investor flows, which were seeking for more attractive yields in other markets. So I think that's what I have to say about what happened to the shilling to cause such a strong depreciation in February. But I also wish to hasten that that depreciation, I think we saw the shilling hit the levels of about 3950 to around 39560. But it has since then clawed back some gains to around 3905 there. And we wait to see what is going to happen going forward. Yep, but like we said, our focus is on inflation outlook that is being caused by that shilling depreciation. Adam?
Yes, quickly to answer Martin's question on exchange rate depreciation. For example, in Feb, the mid rate exchange rate was 3,873.6. Now, the same period, the exchange rate in the same period, that is February 2023, was 3,686. So if we move from 3,686 to 3,874, basically that is an annual depreciation of about 3.something%. Sorry, 5%. The same also applies in January. So on average, once you make the average of the two, you see that the average depreciation in January and February compared the same period in 2023 was basically around 4.1%. So Martin, I hope I have answered you on that. So on exports, if we look, the data we have is up to January 2024. So if you look at 4 months, so 12 months to January 2024, you are talking about the export receipts of goods of around, including gold, of around 7.1 billion. This is up compared to the same period, that is 12 months to January 2023, which was 4.4 billion. So to see that roughly the exports, however, this includes gold. and the gold exports was up substantially. Actually, out of 7.1 billion I'm talking about 2.5 was a result of gold exports. So basically, that's how the exports are performing. Now, even if you exclude gold, you still see that our exports, yes, remain strong, robust, to the range of around $4.8 billion dollars. And most of these, as we know, basically this is coffee and the other commodities, including maize and beans, etc., and manufactured products within the region. So basically, that is how the exports look like. Now, you are talking about capital inflows. I hope you mean FDI. If you mean FDI, again in the 12 months to January, FDI was around 2.9 billion, almost the same as what we had in 12 months to January 2023, although slightly lower, because 12 months to January 2023, we had about $3 billion. I hope, Martin, you meant the total FDI, not necessarily, because capital inflows has both portfolio, has the equity, and it has also the long-term fixed capital flows. I yield back to you.
Okay. Thank you. Deputy Governor, we have to bring this to the end. Okay, there is a last question from Charles Katongore. He's asking whether there are any update on the World Bank's support in relation to the AHA situation.
Charles Katongore, thank you for your question. The last update I had of this was that they were the tail end of the discussions. That was from the Minister of Finance. But Adam, I think you attended the meeting either this week. Do you have any other update from that, Adam?
No, the update I had was that the World Bank had cleared all what the government had submitted in terms of fulfilling their requirements, and therefore they had signed them off. The guidelines on social protection, etc., I think the World Bank had cleared. In other words, now the question was implementation, monitoring the implementation on both old projects and in the coming. So meaning that basically the monitoring implementation meant that, for example, if they are giving a project is in education, they want to monitor to what extent there is no discrimination regarding sexual orientation. So all those guidelines were cleared as submitted by government. World Bank cleared them. And therefore, we believe that this opens up another round, probably for implementation and monitoring, and therefore probably going forward, the projects will be back on in the pipeline. Thank you.
Thank you, Adam. Gigi, there are two more follow-up questions. And these are from Martin Ruza. He's asking, I think, figures about capital inflows, private inflows and private capital remittances.
Okay, Martin Luther, I don't have the balance of payments with me here to really give you the exact numbers in relation to these private inflows and the remittances that you talk about. But maybe, Adam, you have the BOP to answer that question. I don't have it with me here right now.
So I thought I had tried to answer the private inflows, but on no remittances, again, 12 months to January 2024, we had the workers' remittances amounting to about $1.42 billion. This is up from $1.25 billion in the 12 months to January 2023. So that is in terms of workers' remittances. I hope that's what Martin is asking.
Okay. Thank you so much, Ilya. DG sir, we request to close this session, and you permit us to now start the activities related to creating awareness about this. We thank you, our dear stakeholders, for waiting for us. And once again, we apologize for the delay. Good day, and may God bless you. Bye.
Hmm?